Good afternoon, everybody, and welcome to our quarterly fund review. A pleasure to host everybody. I just thought I'll take this opportunity first to thank all of you for supporting us, for wanting to know about us. Some of you are clients, some of you are partners, and some of you really want to know about us. So for all three, thank you very much for coming in and joining us. I also want to take this opportunity to take you through maybe a bit about karma and also the flow of how we're going to do this today. So what we're going to do is I will be just spending a couple of minutes on the firm just to give you a sense of what we are doing. I'm the CEO for the firm. My name is Rajnish Girdhar. I will be handing it over to Rushabh, who is the co-founder and co-CIO for the firm, to give us a little more macro view on what we are seeing on the markets, how we're looking at things. And then I will specifically hand it over to the three portfolio managers, Ekta, who runs our Magnolia strategy, which is our large cap. Then to Vinay, who is the portfolio manager for our flexi cap, all cap strategy, wealth builder, and Jasmine. And then to Darshan Engineer, who is the portfolio manager for the Lotus PMS, which is our small and mid cap portfolio. So without much ado, let me start. Yogesh, can you take it to the next slide and maybe I can just talk about a bit about karma and then we'll take it on from there. Thank you. So I think what I wanted to do in this next couple of minutes or maybe 3-4 minutes is just give you a bit about karma as a background. So as you can see in the slide, we have a fairly long track record. We've been managing money for the last 17 years at Karma. And we've been the two co-founders and two CIOs have been doing this for 30 years. So over a 17-year track record, we've seen multiple cycles. It obviously leads to a much more greater understanding on how to manage money in both upturns and downturns. We've done reasonably well over the last 10 years, delivering about a 20% compounding return. That's about 4% alpha. The broad index, the NSE BSE 500. We are a process-driven thing. So unlike a lot of people, we are not a star fund manager driven approach, even though our two co-CIOs are very well regarded and very well known in the equity markets among all the investment professionals. We like to run a process oriented thing, which means that we can run this over and over again, as we call it, rinse and repeat. And our portfolio is differentiated because of our process. So just to give you a sense, we currently, if you look at our flagship portfolio, it has the highest concentration is on the pharma and the healthcare sector, followed by telecom and media, which is very, very different than index and most other portfolios. Our positions on financial, which is the largest sector weight, is almost 11% versus about 30% for the index. So what it does, it gives a complementarity to your portfolio of equities, and it leads to a better outcome from a volatility and return perspective. We run fairly concentrated, high conviction portfolios. We spend a lot of time on our research, which leads us to very high conviction, typically run 20-25 stocks. Top 10 stocks typically do about 60%, except for the small cap because of the liquidity constraints, where we typically run 30-35 stocks. In our flagship, over the last 10 years, we pride ourselves on the fact that we've lost money in very little stocks, less than 10% of the names. And we have a fairly low churn. So when we buy into an idea, typically we are looking at least a 3-year horizon. Currently, we are running about a 5-year average holding period. Though all cap, we are not small cap, which means that our average weighted market cap is close to 80,000 crores. So we hope that we can provide you returns of a flexi cap with probably more risk characteristics of a largest cap portfolio. And I think that is an important thing. We don't run model portfolios. We don't plug and play, especially on the PMS side. We take our time to deploy. And if there are stocks which we are exiting, we don't normally buy it for the next client who comes in. We think independently. All the 100 odd stocks which finally make it to the portfolio consideration, the financial models are our own. And that time, because we are early in the growth cycle, we call ourselves early cycle investors. Sometimes we can be contrarian. And the reason why we also need to make our own models is because the street either doesn't agree with it, or sometimes they don't even track the stocks that we might end up buying. And I think the last but not the least is the fact that as a boutique, we're still trying to think a bit institutional. Our CIOs spend most of their time on managing money. And in terms of the business function is what I run. So the CEO runs the business function, the compliance operations. whereas the CIOs are free to focus on their energies on the fund management part of it. So this is a brief on Karma. This is why people have looked at us, why clients have spent time with us, and I hope that you continue to be our client for a fairly long period of time if you come in through as well. Without much ado, I will now hand it over to Rushabh to take us through his views on the market, where we are, and I will now take a pause. The questions will be at the end, so please do save your questions. Please do write it in the chat so that we can answer that at the end of it. We hope to complete all of our presentation within the next 30-35 minutes. Thanks, Rushabh. Over to you.
Hi, good afternoon, everyone. My name is Rushabh Sheth. I am Co-CIO and co-founder of Karma. Thanks everyone for attending this. This is our first quarterly call. Hopefully we keep doing this on a regular basis. From my perspective, I'm just going to kind of take you through what we are seeing from a market standpoint. I have three of my colleagues who are going to talk more about our portfolios. So I'm not going to steal the thunder away from them. I'm only going to talk about the broader markets where we are seeing and what we are doing currently from an investment standpoint. So if you look at what we focus on, for us, the most important part is to generate alpha across market cycles. Any investor who's coming to us is really looking at an alpha creation from Karma Capital. If you look at our last 10 years track record, which Rajnish mentioned, we've kind of generated 4% alpha on a yearly basis for the last decade. And from our perspective, we have been doing this in our flagship Karma Wealth Builder, which is now in the new avatar as Jasmine for our domestic investors. And we hope to keep building this in our other two strategies, which are more recent, Lotus and Magnolia. So from our perspective, our job as investors is to generate alpha for people who are coming in and investing with us over long periods of time, creating wealth for our investors in the process. From a market standpoint, I'm not going to bore you, you know more than me. India looks to be in a sweet spot. If you look at geopolitics, if you look at economics, if you look at political environment, I think all of them are favorable to India. So from a country perspective, I don't think so we have been in a better or a sweeter spot than we are today. I mean, we have been doing this for 30 years, as Rajnish mentioned, and it's not many times that we've seen the country in a better position than we are today in. So from our perspective, I think as a country, we have a lot of opportunities coming our way. And as investors, it's our job to kind of keep finding some of these interesting opportunities on the listed market space. We clearly see that there is some concern on valuations. People generally brush this saying that there is a concern on valuations on small and mid cap. I would say there is general concern on valuation on some segments of the market, whether it be small or mid cap or be it large cap. I don't think so. There are pockets of large cap also where there is concern on valuation. So my sense is their concern on valuation is valid. Of course, we are coming out of a very strong 3 years market. And obviously there will be some pockets where valuations have kind of reached maybe a 2 sigma or a 3 sigma levels. But having said that, India is a very broad market. To say that everything is expensive or everything is cheap is not right. From our perspective, what we are looking is finding ideas which are available at a decent price. We are growth at reasonable price investors. So from our perspective, our focus is always on to finding ideas at a reasonable price, whether it be mid, small or large cap. So from our perspective, we continue to do what we do best of finding great ideas. We anticipate growth, we don't chase growth. I think this is very important. So when people talk to us and we say that we are early cycle or counter cyclical, what it means is that we don't like to pay or overpay for growth, but we definitely like to anticipate companies where we see a large growth opportunity and buy them early in the cycle so that we can get them at a reasonable price. I think that's very important to what we do. In India, once the growth gets discovered, it gets very expensive, and therefore it's important to find the growth early in its cycle so that you can buy it at a reasonable price. So from our perspective, we anticipate, we don't chase growth. And from the other thing that you have to see from a cycle perspective, and we always believe everything goes through cycle. When we are at the end of almost a 4-year cycle, COVID started almost 4 years ago, almost at this time. When we were coming out of COVID, people were buying hope, and that was right because you were coming out of a very difficult environment where the mortality itself was at threat. And coming out of that cycle, people were buying hope that things will go back to normal and things will revert back to regression to mean, as we call it. And that was the right trade at that point of time. What we think now has happened is as the markets have matured, as the market cycle has matured, we need to buy cash flows. We need to focus much more on cash flows as compared to hope. And that's really where we would think that our focus would be to finding businesses which are generating a decent level of cash. And most of these companies should have significant free cash flow. The other thing is that the external environment still remains challenging, and there is something which we don't control, and we have no clue of because it's beyond our pay grade to even know what's happening in theaters like Middle East or Ukraine, Russia. So therefore, we need to keep our eyes and ears open. One thing which we feel is that the whole pivot about the interest rates going down clearly seems to be delayed because for whatever it's worth, the inflation is proving to be sticky, especially core inflation is proving to be much stickier. And therefore, I think we will all have to wait maybe a bit longer to see the interest rate cycle turn. So from our perspective, we are keeping things simple. We are wanting to look for great ideas across market cap and across our portfolios. I will let my colleagues and portfolio managers talk more about their individual portfolios. But before I hand over to Ekta, I can rest assure you that we are all working very hard to ensure that our clients make money, and therefore all our portfolios are aligned to ensuring that we have a consistent style and a consistent philosophy across all the portfolios. So I'm going to hand over to Ekta. She looks at Magnolia, which is our large cap strategy. It's a very interesting thing. People keep asking us why we've done large cap in a PMS format, and I'll let Ekta talk more about it. Ekta, it's all yours.
Hi, thank
Thank you.
you. Yeah, thanks, Rushabh. Thank you everyone for joining today. I hope I'm audible to everybody. So what I'll do is I'll take few minutes to talk about Magnolia and then hand it over to Vinay. Very incidentally, last month we finished about a year into Magnolia, and every time we have gone and met clients or investors and introduced Magnolia to them, the first feedback that we have got from most of them is that in large caps, we have not seen mutual funds, outperform consistently over a longer period of time. So in large caps, it's better to do invest through index. And that is exactly what we wanted to challenge through our portfolio, which is Magnolia, and wanted to bust this myth that, in large caps, you cannot generate alpha. The main reason what we have seen over the years, why these mutual funds have not been able to beat the benchmark over a longer period of time is largely built on the portfolio that they have, right? So once you have a certain size and scale, liquidity kind of comes into play, and then it becomes more difficult to have a portfolio which is very different from the benchmark that you have. So you tend to have a portfolio which is very similar to benchmark, where 10% is Reliance, 10% is HDFC, and then expect that portfolio with a very long tail to beat the benchmark is where we see the discrepancy coming into play. And that, which is why we have introduced Magnolia, where we have a large cap bias of at least 70% large cap. But what we provide is a differentiated portfolio, which is completely in line with what Karma follows. So there's nothing different in terms of our philosophy. We are and will remain as a bottom-up stock pickers with growth at reasonable price philosophy, but it will have an overlay of capitalization bias. So we will have at least 70% towards large cap, and then we will have some room for small and mid cap to play with. And that is how we have built this portfolio over the last 1 year. And the performance itself shows that we have been able to beat the benchmark. And we believe that we can continue to do that with the kind of philosophy that we follow in building this portfolio. So, it continues to remain the same of a high conviction concentrated portfolio of about 25 names with a differentiated offering. So if you look at our portfolio, the top 5 names will be very different from, say, a large cap mutual fund portfolio, right? So our top holding would, let's say, be a Tata Motors or a Cipla versus, like I said, what you see in the large cap mutual funds portfolio. Even if you see in the sectorial weights here, you will see healthcare is the largest weight for us at 19%, right? Whereas the index, the weight for healthcare would be somewhere around 4.5. So that itself is a reflection of what I've been saying in terms of the differentiation that we bring into the table, and which is helping us in creating that alpha over the benchmark. Even financials, if you look at, it is about 19% for us. And for benchmark, it's somewhere around 35%. I'm sure everybody is aware. So again, while we have 19%, the top holding in financials for us will be SBI cards compared to, let's say, an HDFC Bank for most of these large cap mutual funds, right? So that's how we have positioned the whole portfolio, where the core genesis of Karma as a whole remains the same, but we will have large cap as a orientation. What we'll do is it will give you that alpha, but it will help us in restricting the volatility, as large cap itself, brings in more stability to the overall portfolio in years of more volatile markets. So if you look at the table downstairs, what you see here is the growth. The more important, I think, the area that you need to focus on is the EPS growth for most of our portfolio companies. There you will see we are expecting a 25% CAGR over the next 2 years for our portfolio companies, right? And so that versus a 20% growth for the Nifty company. So while we have built a large cap, we still expect these companies to have a significant growth over the next 2 years, even in the larger companies that we have invested in. But we are not paying a big price in terms of valuation. So if you look at the PE ratio for our portfolio, it's about 18.5 versus more than 20 times for the index. So this table kind of reflects what we say when we say we look for growth at a reasonable price, right? But still expect the earnings momentum to continue for the next 2 years. What I can do is I can quickly share some investment thesis which will explain our whole philosophy through an example, that like an SBI cards, for example, which is one of our top financial holdings. So for SBI cards, if you can, so industry itself actually crossed a big milestone in February, where the cards outstanding crossed 10 crore cards in February. And SBI Cards is the second largest player, but the only listed standalone credit card player in the market, right? So it has about 19% market share. And what we have seen is that the industry growth over the last 3 years, especially in terms of spends, has been strong and more than 20%. And we expect the spends growth to continue over the next few years. And the whole penetration of credit cards is very small, say around 5% in India. So as this penetration keeps growing with, improving digital infrastructure, the whole acceptance of credit card, and of course the increasing spends. So credit card, SBI cards is kind of a proxy play on the industry spends growth and the increasing consumer spends for India. So as that spends growth keep increasing over the next 2 years, SBI cards will be a direct beneficiary through that spends growth. Of course, another point is that we have not built in this growth is the linking of RuPay credit cards into UPI. So what will this help is this will help the credit card players to tap into the UPI part of the digital payment infrastructure. And SBI cards is the largest RuPay credit card issuer. So they will be the direct beneficiary once this payment structure through UPI picks up. Right. So of course, there has been few headwinds in the last 1 year where regulator has clamped down on the unsecured credit part. But what this has done is because of this, this company is available at reasonable valuation of about 19 times. And this is how it kind of plays into philosophy of growth at reasonable price. So yeah, I think I'm done for my time. What I can do is, this is on the performance part. So you can see in the last 1 year, we have given a 35% return over benchmark return of 30%. And since inception, we have returned about 28% versus 23% for the benchmark index. So yeah, that's a quick snapshot on our performance over the past 1 year. What I will do is now hand it over to Vinay to have a quick word on his part of the portfolio. And then, of course, we can circle back for any questions you have on the Magnolia part.
Thanks, Ekta. I hope I'm audible. Just talking about the market. So again, like last 3 years, we have seen a significant bull run. And again, obviously, we have also delivered around 29-30% CAGR in the last 3 years. But going ahead, what we feel is that one needs to be a little cautious versus the broad-based uptake in the markets in the last 3 years. Going ahead, we feel that it would be largely like stock pickers market. As far as our philosophy goes, and like when we say that we are most of the times contrarian, so in a way we try to avoid crowded spaces. So Ekta mentioned SBI. So this is where, like, if you see the narrative on the street is negative right now on the SBI card, and that is when we feel that we are able to absorb the short-term volatility and maybe think more from a longer term of 3 to 5 years where the company is headed towards. Likewise, again, like because we are tracking companies over longer period of cycles, we are able to identify when the cycle is going to turn. So we put in place a certain amount of catalyst or triggers, and we closely follow each of the companies for to see how the triggers or the catalysts are playing out. And that is the reason why, if you see, most of the time we are largely like again contrarian, and most of the times if the street or the market is looking in one direction, we are largely looking in the opposite direction. SBI Bank again is a prime example. If you see, the street is now, if you see, you've seen the rally in the PSU and the PSU banks over the last 1 year. 2 years or 3 years back, no one was actually talking about SBI Bank. But again, like we invested at around 150 levels and exited closer to around 650, 700 levels in the last quarter. Similar, like couple of examples would be again power and power related equipment companies seems to be like the flavor of the month, so to say. Hitachi Energy is something which we got invested in December of 2020 at around 900 rupees when no one was actually looking at it, and it was available at a multiple of 1 year forward multiple of around 15 times. We exited again that stock at almost 6,000, 6,500 levels, made a decent amount of money. And people are now getting bullish when the stock is trading at around 100, almost 100 times on a 1 year forward multiple. Likewise, again, like there are several examples, even Bosch and Tata Motors, again, when we bought it, say, Tata Motors in 2018 and Bosch in 2020, there was this concern for Tata Motors, again, pertaining to JLR, whether it will be able to compete globally because of their higher share of diesel. And then, if you remember, that is the time when Dieselgate had happened. Bosch, again, there were the concerns with EV coming through. Will Bosch be able to survive? And again, we know how Bosch has done over the last 3 years. So again, this is the kind of ideas what we are trying to look at. And in the current market also, if you see, we feel that there are opportunities in pharma. And within pharma also, we are trying to look for these which have a higher exposure on the domestic play. Because on the domestic front, we clearly see that there is a structural story which is yet to be played out. And again, like domestic business for most of the pharma companies is a highly profitable business. It's a steady business. And in terms of working capital, it's a cash and carry model, and it's a very high cash flow generating business. So that is what we feel. So we keep talking amongst ourselves, and Rushabh sir keeps mentioning this, that pharma is where maybe FMCG was, say, 10 or 15 years back. And right now also, even if you see the three names which we own, Cipla, Zydus and Elchem, they have run up in the last couple of years. But even despite that, on a FY26 basis or on an FY25 basis, they are still available at a reasonable multiple of say around 20 to 25 times versus an FMCG which is trading at almost 50 to 60 times on a 1 year forward basis. Apart from pharma, again, telecom is something which we are bullish on, and auto ancillaries, again, I mentioned about Bosch. We have invested in Varroc and Sansera Engineering as well in the last couple of years, which again we feel that it kind of plays out the manufacturing story here in India. And most of these auto ancillaries are again working on EVs, EV related components. So irrespective of even if the penetration of EV goes up in the future, these companies are expected to benefit out of it. Coming to the portfolio again, like if we see, as you can see in the middle chart on the top side, we are heavy on healthcare. We have been so for the last 2 to 3 years, around 20-25% weight versus benchmark where the weights would be around 6 to 8%. Media is something, again, maybe of the two names which we own, the larger names, TV18 has actually played out well for us. Z, obviously, the merger didn't go through, which was unfortunate, but hopefully from there and these levels, we feel that the stock has bottomed out and should do well. Because again, the industry, we feel that has bottomed out, and going ahead in the next couple of years, again, like with the elections coming through, we feel that the prospects of the broadcasting companies is expected to improve. Other than that, if you see, like again, financials is something which we are at around 10% versus benchmark at almost 1/3. So there are differentiated names in terms of SBI cards, which Ekta mentioned, and we own ICICI Securities over there. And in terms of valuations, if you see, again, on an overall portfolio level, on an FY25 basis, we are still at a comfortable valuation of around 21 times. And if you look at 26, we are still at around 17 and a half times. So again, none of the holdings in a portfolio, you will see that the valuation is trading at around 35 or 40 times, let be 50, 60 times. So we are comfortable, and we are still trying to find ideas which again having a good growth prospect, but again available at a reasonable valuations, because again we are very disciplined when it comes to paying the purchase price whenever we are wanting to invest into a new company. This is the returns which we have generated over the years. Last 1 year again has been good, almost like a closer to an 18-19% sort of an alpha. And over a 3 year period also, if you see, it's almost like 7-8%. And this is what we expect to do going ahead also, consistently delivering alpha over the benchmark. Again, I think there is a rolling return slide as well on the next page. So you see, if you see, irrespective of the timing when you come through, on even on a rolling basis, be it 1 year, 3 year, 5 year, or 10 year, we have like consistently outperformed the benchmark. And again, endeavor would be to continue to do that for our clients. That is from my end. Again, we would be happy to take any questions regarding any of the three strategies. I'll maybe hand it over to Darshan to take it forward.
Hi, can you hear me properly?
Yeah.
Yeah, hi. Good evening, everyone. I'm Darshan Engineer and I manage the small and mid cap strategy at Karma Capital. Can we go to the next slide? Yeah, so just before I go take you through our portfolio strategy for small and mid caps, I just want to give a slight insight on the small and mid cap universe in India. So in India, in a way, is blessed that we have so many listed companies which are spread across a variety of sectors, and this list keeps on expanding every year through IPOs or corporate action. So, and I mean, this we keep getting new and new type of sectors and ways to play the growth story of India. The other aspect, obviously, everybody knows about it, is that over the long term, I mean, if you stay invested in a small and mid cap oriented portfolio, we have seen that the returns are generally very healthy. And if you have a good fund manager managing the portfolio, the returns tend to be quite healthy. The obvious thing right now is that valuation in small and mid cap universe, especially at the index levels, may be looking rich. But that is the beauty of the market, that irrespective of whatever be the level, there is always bottom up opportunities in the small and mid cap universe. There are always ideas available at reasonable valuations. And it's a question of the fund manager finding such stocks at regular intervals so that he can actively participate in them and therefore generate returns for investors. So there's always a bull market going on in some part of the market, be it some sector or the other. And that is why the role of active management is very important in case of small and mid cap fund management, that then only you can discover ideas across sectors or across market caps and therefore be able to generate returns over the long term. Coming to the, if you can move to the next slide, please. So that is where our strategies investing style comes through. So we are, like earlier team members presented, we are a bottom up oriented fund house, and therefore we are always looking out for ideas across market cap. And therefore, I mean, we have a customized and a non-model portfolio approach to constructing portfolio of stocks, especially in case of small and mid caps, because it is not possible to buy the same company at any price. We need to be very cautious at what price and at what entry levels we are doing so. In case of small and mid cap, we have a slightly larger set of companies in a portfolio. We generally run a 30 stock portfolio. There might be some extra stocks or slightly lower stocks here and there, but generally a 30 stock portfolio, in order to ensure that no one stock can adversely impact the portfolio returns in case something goes wrong. So therefore we are able to reduce the concentration risk. The other aspect is that in case of liquidity events, we can quickly generate liquidity for our investors. The nature of companies that we run in small and mid cap portfolio obviously blend in with the larger capital philosophy. We look out for quality companies with strong financials, good management track record, and generally are niche businesses in their respective fields. The investing style is like the broader Karma universe, is growth at a reasonable valuation. We are again early cycle. In case of small and mid cap, as explained earlier, apart from being ahead in terms of the turnaround, we are also trying to be early in terms of identification of the investment theme in terms of discovery. And therefore, if we are early cycle, then generally such stocks are under research. They have low institutional ownership and therefore are available at attractive or reasonable valuations. And finally, the other aspect that we have, especially in small and mid cap strategy, we have seen is the long-term orientation. So especially some of our older clients, because they have been in the system for quite long now, we have seen that the returns generated are much better and the alpha keeps improving over time. If you can go to the next slide. So this portfolio characteristics and statistics in a way highlight what I explained in the previous slide. So as you can see, despite running a small and mid cap portfolio, I mean, the beta is less than 1. The churn is also low. I mean, we tend to buy stocks for the long term and therefore we wish to hold them for the long term. Even though some of the stocks have run up quite a lot, we continue to hold them. At the same time, for new clients, we continue to buy stocks which are still available at reasonable valuations and are adding new stocks into the portfolio as well. So for example, as Vinay explained earlier, we have been in small and mid cap, we have been adding stocks like Sansera, Glenmark Life Sciences. We have been adding stocks like Chola Financial Holding, eClerx. We have got stocks like Apcotex Industries, Narayan Hrudayalaya. So it's a very diversified portfolio spread across sectors, across the small and mid cap universe. Most of these companies are available at reasonable valuations of say less than between 15 to 20 P or even less in some cases. Got good return ratios and good return. One characteristic of especially the small and mid cap stocks in our strategy has been that they are generally cash rich companies or having low net debt to equity. So therefore, as you can see, and while the CAGR obviously is very good in terms of earnings growth over the next 2 years, in terms of it is at around 30%, the return ratios are quite healthy at around 23 to 24%, and the net debt to equity is also like effectively zero. And valuations are reasonable when looked at in the context of the earnings growth going ahead. So if you can go to the next slide, please. So yeah, as you can see, I mean, over the last 1 year, which is where again it has been more than a year now that the Lotus strategy is running, and we have been able to generate healthy alpha over the benchmark. We have generated around 50% return for our oldest clients. So even for new clients, we are outperforming right now. If you can just go back to the previous slide. Yeah, so I just wish to also highlight the fact that in terms of weightages of sectors, as you can see, we are not active heavy overweight on any one particular sector, but we have got a broad diversified set of sectors spread across sectors like industrials, automobiles, financials, consumer durables, and so on. And this, we continue to evaluate and identify new companies. So for example, some of the recent names that we added and have done well for us are Nuama Wealth, KSV Pumps, Bharti Airtel, and companies like Glenmark Life Sciences, Aisha Motors, etc. So hand it back to Rajnish, and we look forward to questions from the audience for any of the strategies. Thank you.
Thank you, everybody. Thanks, Darshan. Thanks, Ekta, Vinay, and Rushabh for very interesting presentations. There are some questions already. I would request everybody, whoever wants to ask a question, to please put it up in the Q&A section, and we will try our best to answer those questions. Let me kind of start addressing these questions and one by one. The first question was, the return shown in the presentation is net of all expenses and performance fee, right? Yes, that's correct. It is. Second question was, I think I'll let Rushabh there. Rushabh, how do you foresee the recent global development between Israel and Iran on our markets and challenges going forward?
Yeah, hi, this is Rushabh. Yeah, thanks, Rajnish. I think it's very difficult to really see the impact in terms of we don't even understand where is this conflict going. It's as I say, sometimes it's beyond our pay grade to even predict where it is going. However, the longer it lasts, the more disruption it is bound to create, because it's a region which is anyway a little volatile. So from our perspective, we need to watch it closely. We need to see where it goes. Hopefully, we kind of start seeing the conflict settle down and some kind of ceasefire agreed to, but very, very difficult to say where it's going. And therefore, we'll have to keep a close eye on it, because the longer it stretches, the more disruption it can cause from a market perspective.
Thank you, Rushabh. I think the good part is both seems to be silent now, so we are hoping it doesn't escalate into a full-scale war. So far, it seems good. Shaunak has asked the question, in case of Jasmine and Magnolia, considering the average holding period of about 5 years, how do you see thematic funds churning the portfolio of about 30%? What is your take on considering client impact, at the same time being consistent with the investment philosophy of GAR? Okay, I think what we are trying to say is, okay, Jasmine is a flexi cap portfolio, Magnolia is a large cap. So I don't think we can really classify them as thematic. Magnolia so far doesn't have a 5-year track record, Jasmine does, and our average portfolio holding is about 5 years. So what is your take on considering, but okay, so I assume you're asking us that is your churn of 30% low or high? But I think, Rushabh, what we can talk about is our churn and being consistent with our investment philosophy of GARP. So I think that's the broad question, and maybe we can address it on an overall basis.
I think, how do you see thematic funds churning the portfolio? Honestly, look, we cannot comment on other people's thematic fund. From our perspective, our churn rate is low. It's about 30% in our flagship strategy. Other two strategies are still pretty young, so it's really not that important. But from our flagship, which has been running for about 16, 17 years, our churn rate has been much lower. Our average holding periods today are about 5 years, but we would generally say between 3 to 5 years. The churn is high. Look, at the end of the day, everybody who runs money has to be comfortable with what they do. I would not say that one is good or one is bad. It's just that somebody has to practice whatever he does with a discipline and ensure that it is a repeatable process over time, which can on a longer term result in value creation for clients. So from our perspective, that's really what we are focused on. We are focused on our process, which hopefully ensures that we build a long-term alpha for our clients, and which we have done over the last 16, 17 years, and therefore over time create wealth for our investors. So I would not say particular strategy is not right or right. I think it is the choice of investors, and also it is the choice of managers and how effectively can they do it.
Rishabh, continuing from the question on Israel and Iran, the extension of this question is, are you expecting any changes to your portfolio in the next 6 to 8 month period if it's highly volatile, oil prices or gold keep going up, and airlines can get hit with changing airline pricing and new sanctions being put on Iran? So anything that you really believe will significantly change in our portfolio?
Our portfolios, again, going back to the previous question, don't change so rapidly. We were asked the same question when inflation was running high in 2022, and we gave the same reply. Our portfolios change very slowly. As relating to oil prices, we really don't know where they are going. We'll have to wait and see. We only believe that from the one airlines that we hold, I think has a reasonable degree of pricing power. And if oil prices go up and stay higher, I think there is enough pricing power in the business to be able to pass on the price increase, but with a lag. So maybe it might take 1 or 2 quarters for them to pass it on. I would say they have significantly more pricing power than many other businesses which will be impacted because of high oil prices. And therefore, from our perspective, the fact that Indigo can raise prices if oil remains high gives us a lot of comfort from an investment standpoint.
Thanks, Rishabh. A question on Z. Z seems to be your one of the top holdings. It has faced multiple headwinds, and it's also got some question marks on the corporate governance. So are these not red flags as you continue to hold it?
Yeah, so let me take this question, and maybe Vinay can add if wherever Vinay wants to kind of jump in. But you are absolutely right. We were surprised when the merger did not go through, because we thought that a merger was win-win for both parties, and it took us by surprise in a negative sense. We will wait and see how this pans out. Clearly, we have taken a knock on the chin because the stock price has reacted negatively to the development. However, having said that, we are cognizant of what is happening inside the business, and the company is taking steps to rectify that. The board has become far more active now. If you would have seen, the chairman of the board has clearly laid out what they are looking to do in the business over the next few quarters. We will wait and watch. Anyway, on our newer clients, we are not adding Z, but for the existing clients, we will wait and watch, because it's not right. We will have to see how the developments happen, and then based on that we can take a call. But you are absolutely right, we are also worried, but that doesn't mean that we will go out and sell the stock tomorrow. We will wait and watch for a few quarters how the developments happen, and we are reassured by the fact that the chairman of the board and members of the board have significantly stepped up their supervision of the business, and hopefully that kind of has more impact on it.
Okay.
Just to add to it, like again, from a business perspective, if you see, again, we are seeing now sort of a consolidation happening on the broadcasting side as well. With consolidation coming through, you start seeing pricing power coming back to the broadcasters. And again, some of the benefits which are already starting to see is the competition for content is already starting to come off. So the earlier prices which people used to pay for, especially for content, has now started to come to a reasonable levels. And especially like, again, right now what you see is on the OTT part, again, most of the companies is, again, IPL is ongoing. You're getting to watch it for free on Geo Cinema right now, but that is certainly not going to continue in the coming season in 2025. So pricing power will increase. It will come back to the hands of these broadcasters, and as an industry, you'll start making money. So mind you, all the cost which is there, which is already there in the P&L. So any incremental price hike which you take on the subscription will directly flow to the bottom line. So from an industry perspective, definitely we are seeing that it is at its bottom, and things will only improve for these companies going ahead.
Thanks, Vinay. One question on our cash level. I believe the current cash allocation is higher than long-term average. Kindly let us know your stand on this.
Yes, absolutely right. We have a slightly higher cash levels as compared to normally. Generally, we are not beyond 5%. Our cash levels are slightly higher than that today because as we sell some of our businesses, which Vinay mentioned for our flagship, we've kind of not found enough interesting ideas at a price. That doesn't mean that we will not find it tomorrow. But yes, today our cash levels are slightly higher. And it's not because we are taking a cash call. It is more a time factor where we have sold something today and we are waiting to buy something. So I think it's more a timing call on our investment rather than timing the market, saying that, look, we have reduced, we've sold our holdings to create cash. It is more one or two complete exits that we have made in the portfolio, which have raised the level of cash. And hopefully we will find over the next few months more ideas to kind of deploy it.
And just to kind of add on our large cap and small and mid cap portfolios, because they're smaller, any new addition of clients, kind of slightly raises the cash level. So they continue to get deployed. What Rushabh was mentioning is about our older strategy, which is the wealth builder of FlexiCap. Coming to the next question, what is the view on consumption vis-a-vis manufacturing sector? Are you overweight on these sectors or underweight?
So let me put some perspective on it. India is domestically driven economy where private consumption expenditure, PCE as they call it, forms almost 60% plus of expense. Manufacturing still is a very small part of the economy. Manufacturing definitely will grow over time. However, the bigger opportunity, at least in the medium term, will remain in a consumption-driven economy in areas where the consumption patterns are shifting, because we also see a shift in consumption pattern across various categories of products, which is visible in the latest consumption expenditure survey which the government had released. So from our perspective, at least in the medium term, it will remain a consumption-driven economy. Maybe manufacturing will inch up a few percentage points on the overall GDP. However, and therefore there will be interesting opportunities on manufacturing as well. And our portfolios also reflect that, where we have both kinds of businesses. We have companies in the consumption space and we have companies in the manufacturing space. So our portfolios reflect that. However, having said that, I think at least in the medium term, India will remain a more consumption heavy economy, and that will not change in a hurry.
Couple of more questions. Thanks, Rushabh. How comfortable are you with the valuations and small and mid cap?
Maybe let me start and maybe Darshan, you can jump in. I think when people do broad brush saying that everything in small and mid cap is cheap or everything in small and mid cap is expensive, I don't think so it works that way. It's not that easy a conversation. It's a very broad brush conversation to say that, small and mid caps are expensive. I started my conversation saying that there are enough and more expensive companies in small and mid cap, but then there are enough and more expensive companies in large caps as well. I would not generalize this. I would say that there are pockets of opportunities, and I'm flipping the question saying that there are pockets of opportunities in small and mid cap, as well as there will be pockets of opportunities in large cap. So I would not want to generalize. Yes, there are pockets of valuation concerns in small and mid cap, but that doesn't mean that everything in small and mid cap is expensive. Maybe Darshan, you want to add something on that?
Yeah. Thanks, Rushabh. As you rightly said, I mean, look, the small and mid cap at an index level may look very overvalued right now, but there are always pockets of opportunity, and I would like to take this opportunity to give an example. For example, Nuvama Wealth Management is one of our recent ideas that we added, especially for the newer clients, and even for the older clients, we were able to add. Now, Nuvama Wealth, I mean, if you see the small and mid cap market has been on a run, say for the past 1 year, but I mean we bought Nuvama at around 3600 and it has already delivered around 35-40% return for even the newer clients. Likewise, there is another company called Glenmark Life Sciences which we were able to buy. I mean, both of Glenmark Life is a API manufacturing company, it's a pharma company, and both of these companies are marked by certain characteristics. They belong to a growth oriented industry. Second, they have good balance sheets with net cash position. Three, they were leaders in their respective fields. For example, Nuvama Wealth is a very good wealth distribution setup, second largest after 361. Similarly, Glenmark Life is a very good business profile in the form of, I mean, manufacturing APIs for a lot of global pharma as well as domestic pharma companies with good EBITDA margins of almost like 30% and having good return ratios. And yet, similarly, even Nuvama Wealth had return ratios upwards of 20%. And despite all of that, I mean, both companies were available at a valuation of around 15 times on a 1 year or 2 year forward earnings with good growth prospects as well. So as Rushabh said, I mean, there are always pockets of opportunity in any kind of market. Even right now, we continue to identify new ideas, and especially there are sectors which haven't really participated in the recent rally because of certain external factors. But hopefully, we see that the cycle is turning in those sectors, and we are identifying opportunities from areas from those sectors, and hopefully we should be able to maybe add 1 or 2 positions from such kind of sectors. So there is always opportunity available at any point in the market, be it a small cap or a mid cap or even large cap.
Having said that, I would say that we will have to work harder. It's more difficult to find opportunities, and therefore all of us will have to put in more sweat and more hours to kind of keep finding newer ideas at a reasonable price. And that's what we are doing. That's what we will keep doing. As a team, we are on the job, and we will continue to work hard to keep finding the ideas which fit into our broader philosophy of growth at a reasonable price.
Okay, we've got 2-3 more questions. One is spike in gold price sustainable? How do you see gold moving on 1 year forward? Word on Vodafone, and there is something more on Z which I will talk about. But first, let's talk on gold and then Vodafone.
Again, beyond our pay grade, gold clearly is reflecting a certain amount of risk premium and also dollar debasement to some extent. As they keep printing more dollars, people will try and find or hide in places where it gives them some hedge over any dollar debasement over time. Gold is one of the best places to hide. So that's one of the reasons, at least that's what I think. Having said that, it's not very easy to say where gold will be in 1 year's time because it is a commodity and it's a volatile commodity. But the dollar debasement trade is more structural in nature because US doesn't seem to be slowing down in terms of printing notes. And therefore, I don't see that challenge going away anytime soon. What was the second one?
A word on Vodafone.
Okay. Yeah, so I think there is a significant effort to revive Vodafone from the governments and from the promoters, and we are seeing a 20,000 crore infusion of funds as a first tranche. I'm sure there will be more infusion of funds as we go along. And of course, people are expecting multiple other levers like maybe price hike post the elections and the AGR decision, which is still pending in the Supreme Court. So yeah, there are multiple triggers. It is important from government standpoint and from customer standpoint that we have at least a 3-player market. India is a very large telco market to have just leave it to 2 players. So I think the efforts are in the right direction. We'll have to wait and see how the efforts pan out. But Vodafone, despite of all that has happened, still has 200 million customers, making it the 7th largest telco in a single country basis anywhere in the world. So it's not a small operator, and therefore we'll have to wait and see how it pans out. But the effort to revive Vodafone is in the right direction, and it's a significant step. The FPO is a significant step.
Okay, I have couple of quick questions. The question is that if you're still positive on Z, why don't you buy it? Especially if it's at a beaten down. And I've seen other managers also do this, specifically with beaten down stocks. So basically,
it's a good.
why are we not adding Z if we believe that the opportunity is good?
Yeah, so it kind of cuts both ways, right? You can flip it and say that why do you have Z, and you can flip it and say, you can buy Z more. Yes, we are cognizant of that. We will buy it at a particular time. You are absolutely right. Valuations, as Vinay explained to you, are beaten down. And from our perspective, we are very closely watching the developments. We have not given up on the stock. We will, at a particular point of time, we are watching a few developments, and if they go in the right direction, we will definitely add on. So we are not averse to adding on beaten down stocks. In fact, that's what we do well, especially where we have high level of conviction, which is the case with Z.
I think we'll probably just take one last question. Some of the recent additions in Jasmine, explain the thesis on them and what are the stocks you've recently sold on the Jasmine portfolio.
Maybe Vinay, you want to take that?
Yeah, sure. So again, Jasmine, if you see, is relatively a new fund, having just 6 to 7 months of existence. But if we talk about the KWB portfolio, which we have been running for the last 15, 16 years, over the last 1 year, if you see, we would have exited SBI. Again, we bought it when it was trading at less than half 1.5x book value. Currently, again, primarily because of valuation, and we feel that there was this euphoria on PSUs, so we thought of exiting that name. Tata Consumer is something, again, when we had bought in at around 150 to 200 levels, it was trading at around 20 times 1 year forward. Now we finally exited in the second quarter at almost 50 times valuation, closer to 1,000 rupee level. Hitachi, I talked about, we again purely because of valuation is something which we exited. And the exits also not sudden exit. We again, while exiting also, we are in a phased manner is what we try to do. In terms of new additions, if you see, in the last 1 year or so, we have added Zydus Life. We have added Glenmark Life. We had added a couple of names on the auto ancillary space, which I spoke about, Verox, Ansera. Consumer durable is something which we have been waiting. We were on the fringe for almost a year, and now last couple of months, we have built in a position on a couple of names, Crompton Consumer in the last couple of quarters. So these are the 5-6, I would say, new names which we have added in both Jasmine and KWB in the last 3 to 4 quarters.
So just to clarify, Jasmine is just the domestic version of our KWB, which is our flagship strategy, which we run for both offshore and onshore clients. We're just making Jasmine a little more less constrained. KWB has a lot more ESG constraints. So we've for domestic clients, we normally don't need those kind of ESG constraints. So we just made it Jasmine. Okay, if there are no more questions, and I think we have actually run over time. Thank you very much, everybody, for joining in. Thank you, Rushabh, Ekta, Vinay, and Darshan, for taking us through your portfolios and talking about the stocks, etc., and the markets. Once again, thank you all for joining us. We hope to see you back in our next quarterly review, which should be towards the middle of June. So thank you, gentlemen and ladies. Have a lovely evening.
Thank you.
Thank you.
Thank you. Thank you. See you. Bye-bye.